Welcome to another Ronel Talks Money Show. Now today we are talking about investing in property, and I know this is definitely a topic that would excite a lot of you, and a lot of you would also have a lot of questions, and we hope to answer all of those questions. But I also want to encourage you to please go and subscribe to the channel, and then click on the link in the description field where we have our monthly giveaway competition, where you can also win one of my books, Financially Fit and Wealthy. Now today, to talk to us about properties, we have Andrew Walker as our special guest. Now Andrew is a property veteran. I know he doesn't look like one, but in the property space, he definitely is one. And he's also the CFO of SA Property Investors Network. And he has personally been involved in more than 600 property transactions, both in South Africa and the UK, where he assisted other investors in building their property portfolio. So there you can see a lot of experience and expertise. Andrew, thanks so much for joining us and welcome.
It is a pleasure, Ronel, and thank you for having me on your show, and a very and a hello to all your listeners.
Thank you. I think they were really excited about today's topic. But Andrew, awesome. Maybe you can just kick off and tell us a little bit more about the SA Property Investors Network and what you do.
Absolutely, yeah. So at the SA Property Investors Network, what we do is we help the average South African go out there and create wealth. And we do that through the memberships of SAPIN. So look, if I give you a bit of history behind why did I start the SA Property Investors Network, it's because back in my UK days when I lived in the UK for 8 years, I built up a property letting agency and I built up my property portfolio, but I was just the average South African living in the UK. And I started with no money. And my success in the UK, where I helped other local UK investors build their portfolios, I did it through networking. Because remember, property is about people. And so when I moved back to South Africa back in 2013, I went out looking for a network of like-minded investors, the average investor who's willing to share ideas, share deals, an environment that you can come into, and it becomes an ecosystem for property investors. Because think about it, as a property investor, I need to know where to buy deals. I need to know what the risks are. I need to know how to get finance. So through the SA Property Investors Network, when you look at the journey of an investor from the start to the finish, we've created this ecosystem with partners like Absa Bank is a partner of the SA Property Investors Network. We are sponsored by the likes of Tile Africa, TUF, working very close with companies like Private Property with the view of how can we, as the giants of South Africa, help the average person create wealth in property. So people join us, they come to the events, they get educated, they get connected, they join one of the 3 membership levels, and then we give them support, and we give them the tools, and we give them the confidence, because that's a big one, Ronel. I don't know if you've seen it, but I see lots of people, they want to invest in property. And the problem is this myth that, people, oh no, but I don't have millions. They think they've got to have millions and millions to get started, or perhaps they've got money, Ronel. And I speak to some of these investors on the ground, and what's holding them back is the fear. So through the network, it's really been set up to help that person get the tools, get the knowledge, get the roadmap, and then overcome those fears and actually start building wealth in property.
Now, that is such a big need for that kind of education, because I think if you just think about property, it's much bigger than thinking about, I want to invest 10,000 in a money market or something, I think just thinking about it is already kind of quite a complicated and a daunting concept. But Andrew, I think you get this question probably all the time, but you can give us your view on it. Is it still a good investment option to invest in property in South Africa specifically?
Okay, so is property investment in South Africa still a good option? The answer is yes. My opinion is the answer is yes. And let me justify why I believe that. Regardless of how the economy is doing, property will never disappear. Everyone in South Africa needs a roof over their head. So yes, there's going to be property cycles. There's going to be, times where the banks don't give us 100% bonds. They give us 70, 80. And I believe that's where the property market is going, where banks will be more cautious. I do believe that, we're entering into a space where we haven't seen the pinch of COVID yet. So look, yes, there's going to be these cycles of property markets going up or down. But Ronel, if you learn the fundamentals of property, if you learn how to buy right, if you learn how to mitigate the risk, you'll be okay. The investors or the people that aren't okay are the individuals that don't know how to manage their financial affairs. And we had the conversation earlier. Are the investors that when things go wrong in property, because there's one guarantee I'll give you, property doesn't always go the right way. You are going to have some hiccups. The question is, who is there to support you? Who can help you overcome the hurdle? Because there's always someone that's had that specific issue. So I've always believed in property from a very young age. And this is the second recession I'm going through. I felt the pinch back in the UK in 2007, 2008. I was busy buying properties. I rode through that storm, and I'm riding through this storm, and I'm looking at the difference of someone that succeeds and someone that doesn't succeed. And it really comes down to, what does an individual actually know? Did they go into the property understanding what the risks are, or did they just sort of go buy a property? Because right now, the amounts of people that come to with 5 properties, I've got 5 properties, and I look at the portfolio going, you've bought 5 liabilities. You are losing money. You've overcapitalized on the property. You haven't bought assets. In fact, your money's better off in the bank. So you've got to be very specific about what you want to achieve out of property. And by getting the right education and having that support network around you, I believe that property is still one of the best investment vehicles out there.
Okay, now I totally agree with you on that one. But what about the pros and the cons when it comes to property investments?
Yeah, so when one wants to get into property investment, or you're already in property investment, some of the pros are, look, if you get it right, remember in property, there's 2 different returns that we get, and we can then combine them. We get the capital growth. Now, in fact, a con could also be negative capital growth. There's certain areas right now in South Africa, in fact, probably 60 to 70% of the country, when you look at the data of the last 10 years, there are a lot of areas that are actually on a downward trend already, so negative. So a pro would be capital growth if you bought in the right area. So imagine you buy a property right now, and now you're getting capital growth and you've bought right. What do I mean by that? You're now getting cash flow, positive cash flow from that property. So effectively getting 2 returns, which you could combine over a period of time. So if you buy right now, that could form part of your retirement plan. That could form, the cash flow every month could help you pay the bills at home if you do buy right. But the big con right now is, what if you get into property and you wear the arrogance hat and you try to do everything yourself and you get it wrong? And now you've got negative cash flow, big risk. There's 2 big risks in property. Your tenant doesn't pay rent, and your tenant then goes and damages the property. Now you've got this asset. You've still got to pay the bond every month. You've still got to pay the rates and taxes every month. You've still got to pay the levies every month. But now your tenant's not paying. That's a massive risk, and that's a big con. And so we need to understand what these risks are. But look, to sum that up, a big pro is you buy right, you could start building a second income stream using property as a vehicle that could form part of your retirement. I've got some students who have actually flipped some properties. They've used the cash of that to pay for university fees. Mm-hmm. They've used the cash to pay bad debt off. And that's a great thing about property, is the sky is the limit, and you can flip. You can run Airbnb, student accommodation, multi-lets, flipping, buy-to-lets. A pro to property is it's such a, and I'm talking about the residential market now, not commercial property. I'm talking residential properties. There's so many different ways of how you can make money out of property, and that is why I get so excited. And as I said, that now the biggest con is you get it wrong, and you could be out of the game, and you could get repossessed, and you don't want to go down that road.
But how would you mitigate those risks? Would it mainly be by education and doing your homework properly, talk to other people, or what else can you do to help you mitigate the risk?
Yeah, absolutely. So I think it's first understanding that before I've got something called the signature solution. It's a 9-step process from becoming this, I want to get into property, I want to do it the right way too, I'm a property tycoon. And part of that signature, the 9-step process, that signature solution, we cover risk. So Ronel, let's say, for example, you want to get into property and you want to do a multi-let. So you want to take a family house and you want to convert it and you want to rent out individual, or you want to get 4 or 5 one-bed flats, right? You've got to understand that if that's the strategy I want to go down, because you should never buy property without having the strategy with the end goal in mind and without the education. Because if you don't, you may go buy a property, you go start building on it, and you've bought wrong. So you pay too much, you've overcapitalized. That's a risk. Why? There's no equity in the property. What happens if you've bought in an area where property prices are on the decline? Something happens in your personal life and you've got to sell the asset. Now you can't sell the asset because you owe too much on the property, and that property price has gone down. So unless you put money in, you can't sell. So that's one of the risks. But now you go buy the property and you put a second or third dwelling on the property, but you don't rezone. You don't get the right building plans and consent. And now you need to sell, because you've always got to think about, what are my exit strategies? And this is happening right now, Ronel. Someone I know, not in the network, just through my contacts, guy did that, 3 cottages on the property. Try to sell the property, no building plans. Bank said, where's the building plans? And a long story short, the building officer came out to try and give consent, but wouldn't because of how they were built. He's now having to knock all 3 cottages down, which then devalues the investment. Now, but this guy thought he was clever. Oh, I don't need to get rezoning. I don't need to do it all the legal way. And now he's going to lose money. That's another risk. So you need to understand how zoning works, subdivision works. How long does it take? Do you have the right town planner if we go down that road? The other thing is, the most basic one is, what about if the tenant does not pay rent? I'll move the tenant in, and there's so many tricks they use. Hey, I'll give you 6 months in advance. Never ever accept 6 months in advance. As soon as I do it, the alarm bells ring for me. I go, why do you want to give me 6 months in advance, right? Mm-hmm. And a lot of letting agents are starting to steer away from that. Or the tenant moves in, Ronel, gives you 1 month's rent, but doesn't pay the next month. What do? So a big risk is tenants not paying rent. But your viewers must know that there's certain insurance products, rental insurance products. I mean, we have a rental insurance product just for our network. So people can take up the rental insurance. They can self-manage using our tech platform, preferential.com. They can take out this insurance to mitigate against, if the tenant doesn't pay rent, the insurance kicks in, the owner still gets paid for up to 4 months. And 1 month's damage on the property. So if the tenant did some damage, and the eviction attorney jumps in and evicts the tenant for the owner. So it takes the hassle and it takes the fear away. And that, to me, Ronel, is probably the biggest risk, because we can show our students how to buy right in the right areas. They've just got to make sure they use the right letting agent. But if they move the wrong tenants in and they don't screen the tenant like they should, and they get a tenant that then trashes the house or doesn't look after the house, and gets up and leaves, and now you get all these arrears. That's one of the biggest risks. But there's ways and means of mitigating it with regards to the systems that you use to get the right tenants in place. And that's probably, Ronel, that's probably a whole session just on its own, is how to evict tenants, how to get the right tenants in. But again, that's the kind of stuff that at the SA Property Investors Network, when we have the evening sessions, some sessions will be future-proofing. We're in COVID. How do you, as a landlord, especially this year, mitigate that risk? It's a very good question.
Mm. And then also in terms of the costs involved, because sometimes people think it's only the price of the property, but there's obviously additional costs that they need to be aware of. Maybe you can also just tell us more about that.
Yeah, absolutely. So when you're going out there, we want to buy a 3-bedroom house, right? It's a freehold house, freestanding, and it's R1 million. Cool. So in the offer to purchase, we'll put that's R1 million, and the seller is going to sell it to the buyer. Remember, the buyer pays all the costs. So as a buyer, I'm now going to pay transfer attorney fees. So the transfer attorney will transfer it from the seller's name to the buyer's name. That takes plus minus 3 months. Now, if you want to know how much transfer attorneys cost, just go online. There's plenty bond calculators. Just Google bond calculator, for example. Standard Bank have got F&B, Uber, and you'll pay, say, 20 grand, 25 grand for transfer attorney fees. If you are applying for a bond, you'll have to pay bond attorney fees, and call that 25,000 rand, just high level numbers for now. So now the buyer must be aware that you must pay the transfer attorney. They will send you an invoice, and the bond attorney will also send you an invoice. And remember this transfer duty of 3%, that's a sliding scale starting from 1 million rand. So you've got to pay a transfer duty, which is a tax you pay to SARS for buying property in South Africa. So those are the major costs. Now, remember that when you buy property, it's common in South Africa for the seller to appoint the attorney. What you'll start seeing over the next few years, I believe that's going to slowly start changing, because we often, as buyers, because think about it, if I'm paying the fees, I should be allowed to choose the attorney I want to use. So a lot of properties we do buy, Ronel, we do actually appoint the attorneys ourselves. Sometimes we use the seller's attorney, but that's starting to slowly change. Now, other costs might be, let's say you're out there and you want to buy this rundown distressed property, or there's a crack. You definitely want to get what's called a property inspector out. So we use Gauteng property inspectors here in Joburg, and there's a few others around the country, and there'll be a cost involved for that. So, Marisha Robus would come out as an example, and she'll do a property inspection. She'll look for damp, she'll look for cracks, she'll jump on the roof. She will look in the what do you call it, in the loft. She's the only lady that's actually been approved in South Africa as a property inspector, which I think is fantastic. And so that'll cost, I don't know, a few thousand rand. If you are buying a property, for example, Ronel, let's say, Ronel, you love the deal, because we have a company called The Brokerage, and Ronel, you want to buy this investment property. It's worth $1 million. We've got it for 700. You may have to pay commission up front. So whether you buy from the brokerage, that's part of our network, or you go to a private auctioneer, or you want to buy from Omniland, which is for deceased estates, you have to pay commission up front. So agents get their commission from the seller. However, if you are buying at the sheriff auction, if you're buying at the private auction, if you're buying from our brokerage, which has investment grade deals, you've also got a budget to have those costs up front. So this is something just to share with you now that I do cover on the one day workshop, where I'll go through the basic numbers, but we'll touch on that later. Where people go wrong, Ronel, is, let's say you buy a property and now you paid your fees and you've taken transfer and the property's vacant. You've got a holding fees. Before you move the tenant in and now you're doing a renovation, you've still got to budget for my monthly bond. You've got to budget for rates and taxes. You've got to budget for levies if applicable. What about your insurance on the property? What about the cost of renovations? So if someone's doing a property project, often they look at the buying costs, they forget about the holding costs. You've got to take a budget. If the builder says it's going to take 3 months, budget 5 months. Builders always go over. It's my biggest thorn in my side. And budget 5 months. You've got to have that cash to pay those expenses. Off the top of my head, I think that covers the basics of the costs.
Mm. And then there's also obviously the tax implications. I think sometimes people, especially now if you invest in property, then you start having like capital gains tax and all of those implications. So maybe you should also just touch on that.
Yeah, sure. And you'll know more about tax than I would. And I'm not a tax expert by any means. So yes, depending on, you'll see in my signature solution I keep talking about, and maybe I should get that for you, I don't know, just so you can share it with your audience. Part of it is, what entity are you buying in? Am I buying in my personal capacity? Am I buying in a company, in a PTY? Am I buying in a trust? Or have I got a structure where the trust owns shares in the company? What I always say to my students is, go get tax advice from a tax specialist. Because if I buy and sell a property in my personal capacity, so 2021, I go out, I flip a property, SARS says that I get a 40,000 Rand capital gains exemption. So I sell the property, I make 100 grand profit, there is a capital gains exemption that I can get. But if I now go do this, and it's capital gains at the effective rates of 18%. But now what happens if I go do 3 or 4 of these? All of a sudden, SARS may turn into, hang on a minute, you are making a living. This is trading. I'm now going to tax you on income tax, not capital gains tax. Okay. Versus, am I flipping in a company? What tax will be taxed in a company will be 28%. Or if I flip a property in a trust, 45%. So depending on the entity I choose will depend on how much tax I pay. And of course, as you know, Ronel, there's ways and means of how can we mitigate that tax. But here is the biggest dilemma. So I'm a property investor. I want to buy through a company. I want a trust structure. I want to leave a legacy. And I want to buy my assets in that property. But now, most property entrepreneurs, I'm sure you've met these people, Ronel. Have you ever come across business owners that want to pay tax?
Not yet.
Not yet. Now they are. Okay, now they are. But now here's the problem. So you got a property entrepreneur, he buys his properties, and there's ways and means of putting expenses through that business. So at the end of the day, you pay no tax. But that investor wants the company to stand surety for the loan in order to go buy more properties and to limit his liability. So he goes to Absa Bank, because Absa Bank is one of our partners. So he goes to Absa Bank and he says, hey, Mr. Absa Bank, I've got these properties, because they are really cash flowing. But Absa Bank goes, cool. Send me your last 3 years of financials and let us see if there's bank affordability. Let us see if this company can stand on its own 2 feet. So you give the financials and the financials actually show a loss, or the financials show no affordability. What do you think the bank's going to say? Of course, no, because there's no affordability. Or do you take the approach where actually you want to show profits? So you set your business up so that company has got great profits. The downside is now you've got to pay tax on it, but the upside is I can keep getting more lending. So what's more important to you as a property entrepreneur? Is it paying less tax, but don't expect to get any bonds through that company unless you stand personal surety for it? Or do you want to pay tax? You pay tax, you pay tax, but now you've got a great company showing good profits where banks are keen to lend on it. So that, that's probably like a good hour consultation, probably with someone like yourself, Ronel, because you're great at that, right? Where you can advise the people based on their goals, where they want to go. Do they want to flip or do they want to do rentals? Are they going to hold it for 1 year or they're going to hold it for 20 years? Because that'll all determine on what structure they should use.
Yeah,
that's not 2 pennies worth.
No, absolutely. And I think on that point, I definitely would recommend that the viewers out there, if you are considering going into property or you are already invested in property, talk to a tax expert and make sure that you know exactly what the implications is, because it can also differ from person to person. So get that advice so that you know you are making the best decisions. But Andrew, you've mentioned now obviously about one kind of return that you can get on a property would be your capital growth, but then there's obviously also your monthly rental income, and that is where your positive cash flow and your negative cash flow concepts will come in as well. But maybe you can just explain that to us, because I believe that is also where a lot of property investors go wrong.
Absolutely, yeah. So I think if I'm going to make the assumption, I'm talking to someone now that maybe never bought an investment property, or you have bought an investment property, but you still don't quite understand it. So let me give an example. Let's say you go buy a new build property, a townhouse, a 2-bedroom flat in a complex. It's off plan or new plan, whatever it is. First of all, don't get caught out by when the companies say, yeah, I'm going to give you guaranteed rent for 12 months, right? Don't be caught out by that, because what you're really going to look at is if I pay 700,000 Rand for this property, you need to work out what your monthly bond payment's going to be, number one. The other factor you have to look at, what about levies? Often levies is what kills these type of deals. Obviously, levies wouldn't be applicable in a freestanding house, but let's say that there are levies. So now I've got my bond payment, I've got my levies payment. What about rates and taxes? We've got to be paying rates and taxes. Some people still think that that's for the tenant's account. No, it's for the landlord account. So now I've got to budget for the monthly bond. Now I've got to budget for levies. Now I've got to budget for rates and taxes. When you're starting out a property, do not even consider managing it yourself. Don't do that. It's the biggest mistake, right? Get a professional letting agent or use preferential.com, which is a tech-based business to help you manage the property, to give you all the right OTPs and everything. But there's a cost involved. So you may we always teach our students work on 10% of the gross rent. So if the rent is 7,000 Rand, in your budget, have 700 Rand as a budget to pay a professional to help you manage it. But now what about general maintenance? Oh, but Andrew, it's a new build property. I know it's a new build property. And the chances are, yes, the first few years, you should have less maintenance. That's the theory behind it, depending how good the developer was. But it's good practice to take a percentage of the gross rent that goes into a kitty. So have a separate account. It's called the kitty account. So now you've got your bond coming off, you've got your rates and taxes, you've got your levies, you've got your management, and you've got your maintenance. That maintenance, and even on top of that, now what about your voids? No? What if the tenant moves out in 1 year and now you've got a void gap? So the property's empty for 2 months and now you can do a lick of paint. Where's that money coming from? Because while that property is empty for 2 months, who now is paying the monthly bond, the rates and taxes and the levies? You're still paying it. So that money is going to come from somewhere. So don't just think that the tenant is going to cover all your expenses the whole time. You've got to cater for vacancies. What if there's one month vacant a year? What if there's a lick of paint you're going to do when the tenant moves out and a new tenant's going to move in? So from a basic understanding, don't forget about the general maintenance, the voids the vacancies that you might have, and management fees. Those are the 3 components right now that I found the average South African doesn't look at, because when they buy the investment property, the majority of people that sell those type of investments, they don't give them all those hidden costs, but they aren't even hidden costs, but they don't tell them about it. So the person goes, oh, but the rent 7,000 Rand is going to pay for the bond. The bond is 7,000 Rand. Cool, so the bond's covered. But they forget, or they don't look at all the other costs. Now they're in this deal going, but I'm actually losing money. But Ronel, it's okay. Do you know why? Because from their job. So their job is paying for the extras. But now, Ronel, can you answer this question for me? If they lose their job and that income stream stops, who pays the shortfall? Where does it come from?
Yes.
And now imagine you got 4 properties. You're losing 2,000-3,000 Rand a month on each property, but it's okay because you've got this great job and you're earning 200 grand a month, but you get retrenched, you lose that. Now you've got this portfolio that is actually meant to help you get financially free. That property portfolio is meant to help you in your financial life. Now all of a sudden it's becoming a drain because you haven't taken all those costs into consideration. And that to me, and right now I see that on a weekly basis. And that comes down to a lack of how do I do it right? And where do I find these cash flow positive properties?
Yeah,
so did that answer your question?
Yes, I absolutely love the idea of having all of those different accounts set up to make provision for all of those costs. That's also something that I always teach or guide my people to do as well in terms of general personal finances. But I think then if we can just summarize, then a positive cash flow property would typically be where your rental income would exceed basically your bond payment as well as all the other additional costs. So once you have a positive there, then it's a positive cash flow. But if your rental income doesn't exceed basically your bond costs as well as all the other additional ones, you have a negative cash flow.
Exactly, because if you think about it, right, when we use the word invest, the word invest means I'm going to put time and money into something that should give me a return because I'm investing in it and I expect to get a return. Now, if you end up with a property right now where at the end of the month, it's a negative. So I'm not making a return on the cash flow. Cool, that's fine. Let me look at the capital growth. Oh, but there's been no capital growth. I'm not getting the return. So I'll put money in to buy it. I'll put time in to buy it and manage it, but there's no return. And so one of the important calculations that the listeners need to know about is what we call return on investment. So what is that annual return? Argument's sake, let's say it's 1,000 Rand a month. I'm making positive after all those expenses. I times that by 12 to get my 12,000 Rand. That is a return on an annual basis. And what I want to do, Ronel, is divide that by the investment I've made. Well, what's the investment I've made? Well, I had to put 50,000 Rand of buying costs in. I had to put 50,000 Rand of renovation and holding costs in. So my capital cost for that deal was 100,000. So what I look at doing is taking the annual 12,000 Rand divide it by the 100, by the 100,000, times that by 100 to get a percentage, and I can look at what return do I get. And for example, let's say that return comes to 2%, right? I'm then going to take a view and go, what if I don't get capital growth? That 100,000 Rand I invested, I'll get a higher return in the bank. At least the banks will give me 5% or 7%. So the return will be higher in the bank. And this is what the people need to understand, are the basic calculations. Now, for some people, that might be very difficult to comprehend. You know, when I first started, Ronel, I used to be a sound engineer. And when people told me about return on investment and gross yield, I was like, what the hell are you talking about? It took me like 6 months to understand the concept. So if anyone's listening to this and you're like, Andrew, I don't understand the numbers, you're in the right place, because Ronel, that's what you're very good at. And we teach that on the one-day wealth builder workshop, because people have to understand what that looks like from a property perspective.
Yeah, no, I totally agree with you on that one. I think there's so many people who are not aware, and I think sometimes people don't have the confidence in asking, because you go to any kind of webinar or seminar or something and you hear these words, but you don't know what it means or how to calculate it. Yes. Or once you have calculated, what does it actually tell you, and what should you make with that kind of answer that it provides you. But apart from the return on investment, because that's probably your most valuable calculation, but would there be other calculations and ratios that's important for property investors?
No, absolutely. Look, I think for people starting out, like you said, that's the most important one. You've also got to understand the cash flow, very basic calculation, but it is different. If you're doing a buy-to-let in a complex or in a family house, the figures we use in the cash flow are slightly different. If I go to student accommodation, that cash flow is going to be slightly different, because I've got to add, what about the cleaner? What about the Wi-Fi? What about the communals? If I was to a commercial building, so first thing is understanding how gross cash flow works. Income minus what expenses do I take into consideration for that type of property? Because most South Africans will always invest in a townhouse. They'll go buy a 2-3 bedroom place from a developer off plan, and that's all they know. But when you really get into property, understand the different strategies, rent to rent, Airbnb, all different types of investment, they need to understand how those cash flows work. One other thing we teach is gross yield. So what's the gross rent? Well, let's call it 10,000 Rand a month. It's 120,000 Rand a year divided by the asset value. That gives me an indication as to whether that property is going to be cash flow positive or negative. It's an indication if it's going to be positive or negative. What about flipping properties? Whole different ballgame. I'm going to buy the property. I'm going to sell the property. How does that calculation work? And again, if I'm buying it the conventional way versus doing what we call a simultaneous transfer or doing it through an assisted sale, those calculations are all different. And this is one of the most fundamental parts of property investing right now. You know, whether they can get that from yourself or they get it from us doesn't matter. They've just got to learn what are all those different calculations? Because if you think about it, how do you know what a good or bad deal is? What makes a deal good or bad? You know, because I see people going from an investment point of view. Oh, but Andrew, the kitchen was great, the bathroom was beautiful, and they buy it because of that. I'm like, but that doesn't make the investment great. And yes, it's in a good area, but have a look at this. You're losing 4,000 Rand a month. So what makes it? What's a good deal? What's a bad deal? We can have that debate all day long, you know. So I think if they learn those basic calculations, understand gross yield, understand return on investment, understand the different cash flows for all the different strategies, that will get you on the journey. And from there, you can start maybe learning about return on equity. When should you sell a property? When should you dispose of a property? And that's a whole different calculation.
Yeah, and I think it's so important to know that when you do invest in property, like you said, it's not about the emotion. It's not about how pretty it looks or it's in this kind of stunning suburb or whatever. It's all about the numbers should make sense, because at the end of the day, it's an investment and you want the best return for your investment. But I think people would also think that a lot of them are interested in buying property, but probably that one thing that's always holding them back is that I might not have enough cash, or I might not have the funds available to invest in property. So maybe you should also just talk to us about that. What's the options available for people to still get into property, even though they don't have money available according to them?
Sure, so 100%, and I guess that was me, 25 years old in London, went there with a few £100. I had zero cash. Let's start with bank affordability. It's the most common one. When I think banks, you're thinking Nedbank, Standard Bank, FNB, all those banks, of course. But there's other banks out there, Ronel. Sentinel Homes. What about TAF? TAF is one of our sponsors. TAF work with property entrepreneurs. They have access to what's called the Untutuki Fund. So TAF, for example, unlike a traditional bank, they will look at you and they'll look at your experience perhaps, or they'll look at where are you operating, and what they do is they'll lend up to 80% of the whole project, not just the purchase price, the whole project. They can then give you access to the Untutuki Fund, which is a fund to help people get into the property investment space on a very good interest rate, like prime minus, and up to 10%. So now all of a sudden, between TAF and Untutuki, they've given you 90%. Yes, you've got to find 10%. And that's often the problem. So what you need to realize is that there are investors out there that are looking for returns right now, but aren't necessarily interested in the property, in the actual property investment. They've got money sat in the bank, they're sitting on cash, they don't have time to invest in property, but they are willing to do joint ventures with eager property entrepreneurs. They are willing to invest in a project for a year or 2 years to get a 15% return or a 20% return. So, where people are out there and they don't have the capacity to actually get the bond perhaps, or they don't have any capital. I spend like an hour on this specific question, but basically, if I shorten it, that individual like myself, I had to do what's called a joint venture with someone that had the bond affordability and had the cash. So I took a percentage of the profits of that property, but it got me in the game. So what I do for that, I found the property, I managed the property, I did the renovation, I did all the legwork. And I teamed up with someone that could bring the finance. It could be a mix that someone's watching this going, but Andrew, I can get bond affordability. I'm employed full time. First thing I need to realize is how much bond affordability can you get? And we do have a finance specialist who does that for us. And again, if we're doing it through a personal or through a company, we'll also determine how much affordability we can actually get. Because there are people out there right now that we work with that are unemployed now, that have been retrenched because of COVID. It doesn't mean they can't do properties. Ronel, have you ever heard of installment sale agreements?
Yes, I have.
Okay, so we've done quite a lot of those recently during COVID, where we've taken over people's bonds. We've taken over control. We are then doing all the maintenance, the management, and we're agreeing 5-year, 10 years. So of course, you've got to understand how you're going to buy that property in the future, or you may end up flipping the property in the future. But people need to understand that there's strategies like installment sale agreements, that you can do joint ventures with other investors that will team up with you. You can go to the SA Property Investors Network and you can raise cash from investors. There are some people out there, Ronel, as you know, that are sitting on good cash, and they'll be more than happy to invest with an investor who's got some education, who is a local expert in their area. They understand what they're investing in, and they can share what the risks are with the investor, and they can negotiate how they're going to pay back. So, but the starting point is, can you get bank affordability? And you must know with the banks, I've seen it already, Ronel. I've seen Standard Bank, in my opinion, has been the most aggressive bank. For the first time ever, we're starting to get not 100% bonds from them, but 80%, 75%. Don't get me wrong, they'll still give 100% bond, but before, almost every application, we were putting in 100%, 100%. And so people must realize that, I believe, and I think the same as you, Ronel, banks are going to be a bit more cautious because we're entering into uncertain space. So from a bank affordability point of view, can you afford the bond, but can you afford the deposit if they only give you 80%? So that's something to consider, because banks like ABSA, for example, if you bank with them, they should give you the 100% bond. But if you go to ABSA as a non-ABSA bank clients, you'll probably only get 80%. So I think it's for people that are interested in the subject right now, that want to know all these different ways of structuring deals if they can't get bank affordability or they're limited. They'll probably need to just attend maybe one of the workshops where they learn, where they get all the ideas of how to structure all the different property strategies.
Yeah, so I think it's always important not to overcommit yourself and to make sure that you are kind of taking or making responsible decisions. But the good news is that there are plenty of options out
Yes.
there. So that shouldn't be your excuse that you don't have money, you can't invest in property.
Exactly, 100%. There's different ways and means, but you've got to understand. I think the biggest thing, Ronel, is for people that do want to get creative and they want to learn these different strategies, part of that education is, what if the deal goes bad? What if you can't remortgage? What are those exits? Everyone should be writing down exit strategies. It's something which we're very big on. Because I've worn the t-shirt where a deal hasn't gone right. Now I've got an investor's money, like 500,000 Rand in the deal, but I can't remortgage a deal. What do I do? And people need to understand that, cool, I can show you all how to put these deals together, but now we must bring up, what if the deal doesn't go according to plan? How do you pay that person back? How do you manage that relationship?
Absolutely. Andrew, you've mentioned a couple of times about flipping properties as well as buy to let. Maybe you should just quickly explain those two different concepts.
Yeah, sure. So look, a buy to let is a property that I'm going to go buy. Say, for example, a 1-bed flat or a 3-bed flat, even a house, and I want to rent it out for the long term. So I'm going to buy it to let it out. There's one lease agreement. So there could be a family, there could be a couple, there could be one person. And I'm going to rent that property for 1 year, and I'm going to use a lease agreement. So that tenant will sign the lease, I'll sign the lease, and the lease will say, great, you have occupational rights for the 12 months. You're going to pay me 10,000 Rand. And it should just be as simple as that. And that is called a buy to let. I'm holding for the long term. Then we have what we call flipping, buying to sell. So I don't know, in fact, this morning, I went to a deceased estate, and you must see this property here. Yo, it's bad. We're going to pick it up for about 450,000, and we're probably going to spend about 400,000 on it. So 850, win the deal for 900. And we were having a question: do we hold it? Do we do a multi-let where we take the property to 1,000 square meters and we chop it up and we rent individual bedrooms or flats? And I said to the guys, you know what? I think we should just flip this property. If we can pick this up for even say 450, right? With commission 500. We spend 400,000, that's 900. We could probably sell that property for 1.4 million. So now we buy it, we renovate it, and we sell it straight away. And with the profit in that deal, the net profit, after all, because there's tax, there's expenses, it's probably about 200. Maybe 250,000. Now what I have right now is I've now got a pot of cash, 250,000 as an example. Now I can take the 250,000 and I can invest in my long-term assets. So we use flipping as a short-term solution. Or you flip a property, you've got 250,000. I could reinvest it, or it could be that someone's got bad debt. You could use part of it to pay bad debt down. You could use it to pay your residential bond where you live down. The great thing is you have options. You can use it for what you want. So flipping, short-term strategy, get lump sums of cash, whereas the buy-to-let and the multi-let are your long-term rental, where the idea is you want to hold these for the next 20, 30 years. You want to take advantage of the positive cash flow as well as the capital growth. And if you get that right, that's what I call real wealth. Remember, cash flow makes you rich. Equity builds you wealth. Big difference.
No, and I think that is so important for people to know in terms of what strategy and kind of like what's their goals, because that will basically determine kind of what you are going to do. But then also, what about a location? How important is location really?
Very important. That's always important. I remember in the UK, there's a program called Location. The thing is, if you want to be, buying a property, prime example here in Primrose, we flipped a property back in the day, and it was on the wrong end of the road. We struggled to sell the property, right? There was a squatter camp very near, and it was putting a lot of buyers off. And we did sell the property in the end, but it was one long road. The one end of the road, we had a very good reputation, and the other end of the road was a little bit iffy, right? It wasn't great. And I'm going back years and years now. But because we bought, and it's a mistake I made, because we bought on the wrong end of the road, we struggled to sell. It took longer to sell. And I'll say every area right now, My coach 15 years ago said this to me about location. I want you to get a map, okay? Go get 3 highlighters, a red, an orange, and a green. Think of a robot. They call them traffic lights overseas. And he says, think of a traffic light, a robot. Red means stop, do not go. If you go, it's dangerous. Amber, orange, amber is you can go, but be cautious, but just be aware. And then green is like, you can go, it's affluent. Think of an area now. So I'll go to a letting agent, right? I'll say here in Edenville, and I can go to a letting agent and say, here is a map. Here are 3 colors. Here's the red. Can you please highlight where I must not buy? These are antisocial behavioral. These are drug dealers. These are areas where if you buy, you've got to go with a gun, right? Because if you, now here's the thing right now, people get caught up because the deal looks fantastic. This is way below market value for a reason. That the person that's selling just wants to get out because it's a really bad area. And that's going to affect the property prices. That's going to affect tenants moving in, tenants moving out. Why? Because next door's a drug dealer. That's a bad area. Then you take the orange. The amber areas are the areas where we tend to invest. Not always areas where we want to maybe live, but the areas where there's a great rental market. There's a the yields work, the gross yields work, we're getting returns, and then you get your affluent areas. These are areas where capital growth has shot up and rental prices haven't followed, and therefore there's no way the buy-to-let strategy is going to work. There's no way we'll get a positive cash flow, but if you flip in that area, you'll sell that property very quickly and you're going to get good capital growth. So location within a location is very key. And think about it in the world, not just South Africa. In every town, there's always, don't buy on that end of the road, but that end of the road is fine. Or there's the good parts and the bad parts of every area. And that's going to affect the capital growth of that property. That's going to affect how much, what your vacancy rate is going to be. And that's just going to affect the headache that you have with the property. So the very first thing I was ever taught by my property coach, and it's something which I teach my students, become the local expert in an area. Know what end of the road is good and bad, because it's a good question, Ronel. It's going to affect your property investment. That end of the road, we can sell properties, and that's the property as of today. That end of the road, I know we can sell for probably 1.8, but this end, the property I looked at today, probably 1.3 because of where it is. It's on the wrong end. It'll still sell, but for a lot less. Here's the problem right now. If I don't do the research and I go download the Lightstone report that you get in the membership with SAPIN, and I pick up sold comparables on the road, but I don't think of the different ends of the road, and I pick up all the high comparables, I don't think that I can sell this property for the same price, but I can't. And now I've run my numbers on 1.8 million, but then I put the property in the market to realize I can only sell for 1.3. I've got a problem on my hands.
No, absolutely.
So I'm very passionate about it.
But that's actually good.
Exactly.
Andrew, I think we have discussed quite a lot, but there's still so much more that we can discuss, and I definitely would love to invite you back at some point.
Absolutely.
I just want to ask you the last question. What
Sure.
would your tips be for somebody who would like to get into investing in property?
Okay, so the first tip is understanding why do you want to get into property? What is the reason why you're doing this? You've got to understand why you're getting to number one. Number two, you've got to then realize, what do I want to achieve out of property? Am I looking for retirement? Am I looking for short-term solutions, short-term cash flow? Am I looking at just building a second income stream? So now I know why I'm doing it and what I want to achieve. Those are the first two things your listeners must ask themselves. The third thing, and this is all part of my signature solution. The third thing is then, okay, great. I now know that I want to do multi-lets, as an example, in Edenville. So you start working out, what do you need to do? You have to get the required education. So if I want to buy to let, go do a buy to let course. Go get a property coach that can guide you along the journey to do buy to lets. Why? You want to minimize the mistakes. So those are the first few steps you take. Why do I want to do it? What do I want to achieve? And what do I need to help me achieve it? What are the tools and resources? So, for example, in the membership of SAPIN, Ronel, you need to download Lightstone reports, TPN reports. We need those tools and resources to help us analyze if the deal's going to work. So once you've worked out what you want to get and why you want to do it, Next question is, where do I get support from? Where can I ask my questions? Where's that network of investors that can say, yes, your next step is A, B, C, whatever it's going to be? Or you short of cash? Where do you go raise the money? So before you buy that property, you've got to understand who your support team is going to be. And once you've got the why, the what, and the tools and the resources, and you've laid your roadmap out very clearly, it makes the whole journey a lot easier. Because some people don't know, they jump into a property, they go, which is number 6 on my signature solution. They go put the offer to purchase, and they haven't looked at anything else. They don't have a blueprint. They don't have the right structure. They have no idea what the risks are. And that is where people lose money in property. So they've just got to follow the signature solution step by step. And that's going to cover the why, the what, the how. The how will come in, the plan, the blueprint will come in. And we've seen it with the success of our students. Once you follow that proven method, it just everything falls into line.
Okay. Andrew, thank you so much. You have shared so much insightful information, and I would really like to encourage the viewers. I am going to share the website details below. I've attended many of the SA Property Investors Network's webinars. Go and attend. There's a free webinar, so you can really educate yourself. So please go and have a look in terms of what they are offering. Andrew, again, thanks for spending some time with us. And then to all the viewers, please comment if you have some questions. Ask them below in the comment field. We will get back to you on those questions. Remember to subscribe to the channel, and I hope you have received good value from this session. Then I will see you again at the next Ronel Talks Money show.